Yeah, we'll say that should remind you to share the Zoom link.
Or he can use the same Zoom link. Can you text him or something?
Okay.
Well, he's here, sure.
Okay.
So can you hear me?
Yeah, I can hear it.
Okay, and let me ask you this. What do you see on your screen? Do you see both the board, whiteboard, and the slide?
Yeah, I see the slides.
So what about the whiteboard? Do you see the board?
Yeah.
I couldn't hear you. Do you see the whiteboard?
Yeah, I see both of them.
You see both of them? Both are like.
Yeah.
So if I write something, can you read it? For example, let me write down, let's say, RITPIT. Can you still read it?
It's a little bit invisible, small maybe.
Small. So do you see the whiteboard and the slide
Yeah, both
next
of
to
them.
each other? Next, like side by side, or you see one on top of another?
Yes, side by side.
Side by side, okay. So do you think is it better?
Oh, now I see, yeah.
You see everything?
Yeah.
Okay.
Mm.
Okay. Good afternoon, guys. How are you?
Very good.
Okay. Okay, guys, welcome. So we are going to cover chapter 3. The chapter 3 is about asset allocation, the mean variance framework. You probably have seen this in your investment class. Does anyone remember mean variance framework? Something like this. Do you guys remember? That's okay. We are going to cover in depth actually. We cannot discuss asset allocation without talking about mean variance framework. Zoom is not helping me here. Just give me a second. I want to fix this. Okay. So mean is average. Variance, we all know. Variance is a measure of risk. You take the square root of it. It is a standard deviation. So mean variance framework means in finance, remember, we do not talk about only return or only risk. We have to talk both at the same time. So that is where this idea comes from, mean variance framework. So asset allocation is a term used to describe the set of weights of broad classes. Give me some examples of broad asset classes.
Asset classes. No.
Stocks is one, yes, equity. And bond is another, we say fixed income, right? Commodities, these are different asset classes. And when we talk about a portfolio, our portfolio may include both equity and bond, or it can include also other asset classes like commodities, like gold and silver, right? There are reasons to believe that some commodities work as good hedge for inflation. Real estate is another asset class. Hedge fund also can be considered a different type of asset class, right? So when we talk about a portfolio, our portfolio may include 2 or more of these different asset classes. And we have different objectives for including each asset class or some of them in our portfolio. So when we say we want to include different asset classes, so we have to come up with what % of our portfolio should go to equity. What % of our portfolio should go to fixed income? Let's say in a very simple portfolio, we have only equity and fixed income. Bond is an example of fixed income. So one way to think about it is an example. Of course, it depends on risk. Think about an individual investor, right? You guys are young, so you can take more risk. So you will probably allocate more in your retirement fund. Let's say we are talking about retirement fund. You will allocate more, let's say 90% towards equity, 10% toward fixed income. As you grow older, it will shift more towards fixed income and less towards equity. And we have seen that in the previous class too, right? a little bit. But how to come up with this, right? Well, should it be 90%? Should it be 80%? So asset allocation addresses this, and mean variance framework is a quantitative framework to help us address this question. So there are different kinds of asset allocation. One is strategic, it's a long term. Let's say you set allocation 50% equity, 50% bond. I'm of course making up some numbers here. And you don't want to change them every now and then. For example, if stock market goes down, you think it's a good opportunity to buy the dip, right? But you don't do that. That is not strategic asset allocation, right? If you respond to the market every now and then. Tactical asset allocation is you do respond, right? But it doesn't mean you change your portfolio allocation every day, right? Tactical, yes, there is a spectrum of active management, right? How active you want to be. One problem with active management is there is a lot of turnover. If there is a lot of turnover, buy, sell, a lot of trading cost, and you may have to realize capital gain, so that will increase your cost, right? So all those issues are there, but tactical allocation gives you more flexibility. As a portfolio manager, you get more flexibility to respond to market changes. For example, you think a small cap is undervalued now because everyone is interested in large cap like NVIDIA. So it is overbought. The small cap has been given up or overlooked, right? So you want to take that opportunity as a portfolio manager. And remember the two categories of investment management I mentioned. One is active, another is passive, right?
Yeah.
So when we talk about tactical allocation, it gives portfolio managers some leeway, some flexibility. One way we allow this flexibility, or portfolio managers can be allowed this flexibility, is we can set a band. For example, let's say our long-term strategic allocation is 50% equity, 50% bond, right? But market changes all the time. Let's say after 1 month, equity market goes up, so allocation also changes, right? So allocation may go now to 50.5% to equity and 49.5% to bond. So does it mean you should go as a portfolio manager and reallocate by buying and selling? Again, you have to consider the transaction cost and other issues, right? So if you have a band, for example, in this case, 50% is a wide band, 10% over and 10% under, right? Portfolio manager has flexibility to move allocation around this, within this band, depending on market opportunities, right? But regardless, they cannot go above 60% for equity, below 40% for equity. It doesn't have to be 10%, it could be 5%, right? It depends on your risk tolerance. Remember risk tolerance we talked about? Dynamic allocation is more complex. It is more appropriate for institutional investors. Driven by changes in risk tolerance. For example, portfolio insurance is an example of dynamic allocation. Does everyone know what is a put option? More or less, Rick knows. So options, you know, right? What are options?
Obligation to buy,
Yes,
obligation.
not an obligation, because the word
The right,
option,
okay, the
that's,
rights.
yeah, the right to buy, right to sell. Call option, right to buy. Put option, right to sell. At a specific price called strike price. So obviously, if you are risk averse and you have equity and you think you will need money after 1 month, but anything can happen in 1 month, so you can buy put option to limit your losses.
Yeah.
For example, you have NVIDIA shares. NVIDIA's earnings was announced yesterday, right? So it went down a little bit. So anyway, whatever the reasons, earnings announcement, etc. So you want to make sure you get minimum amount for each share by selling your share in case you have to sell. So put option, you can buy put option that gives you that right, but not an obligation, right? If the share price goes up, you will not exercise the put option. What is your loss? The premium you paid. So for example, these are options on NVIDIA, right? All options. Put options. So for example, we talk about put option. So this will expire on August 29. Let's look into a little further. Let's October 3. So if you buy this option and how much is the market price? 180.17. So if you want to guarantee this price that you will get. So these are the prices you have to pay, premiums, bid and ask. Ask means you have to pay if you want to buy the put option. Bid means, let's say after you bought this option at the ask price, after a few days, you became more confident. No, NVIDIA share price will not go down. So you don't need the options anymore. You can sell them and you'll sell at the bid price, right? So first of all, I explain put option. Synthetic means sometimes you may not be able to buy put option at a strike price you want, or there may be other reasons. Market may not be very liquid for that particular instrument. Maybe it is not a stock, it is a very different complicated instrument for which you want to buy a put option on. In that case, you can actually trade futures, right? For example, when the market falls, you can short futures, you can sell futures. So if the market goes down further, you'll gain from the short position. And your loss from the long position in the equity will be offset to a certain extent. To what extent depends on your short position, right? How much you want to safeguard. Going back to asset classes. So we talked about tactical, strategic, and dynamic allocation. So when we say asset classes, generally groups of securities with similar characteristics. For example, equity. Equity includes the small cap, mid cap, large cap, mega cap, micro cap, so many names, right? But they have some significant similarity. They tend to move together to a certain extent. Of course, a small cap behave differently from large cap, right? But within the equity, they have strong correlation, relatively speaking. But if you look into the correlation between equity and bond, it is less stronger, right? And that is one reason why we use different asset classes in our portfolio, because lower correlation means it offers diversification benefit. It reduces risk, right? It reduces risk. Here you will see, if we look into the correlations from 45 years, ending December 31st, 2016. So within equity, we also divided a small cap, large cap, but you'll see small cap with large cap, their correlation is 76%, high, right? What is the maximum value of correlation? 1, right? +1 and -1, right?
Mhm.
Now, if you look into the correlation between US corporate bond with US government bond, also high, right? 0.88, relatively speaking. But if you look into small cap, large cap, which is equity, with a bond, negligible,
Yeah.
right?
Minus.
It is all over a long period of time, 45 years. Most of us probably, at least when you have enough money to construct a portfolio, don't have the luxury of making these assumptions, right? So that is where things get much more complicated. If you look into the returns and risks, I believe over the same time period, ending December 31st, 2016, what do you see? Do the small cap generate higher returns generally than the large cap?
Overall?
Yeah, right?
Overall, yeah.
Overall, yeah, right? So small cap 13.3% versus large cap 10% over last 60 years.
Yeah.
So it is a longer sample actually.
Mhm.
So 45 years, yes, last 30 years, not a lot of difference.
Yeah.
20 years difference,
Mhm.
not much difference, little bit, right? So, but generally speaking, over a longer period of time, the small cap stock tends to generate higher return, but at the expense of what? Now let's look at the risk, standard deviation. They also tend to have higher risk, right? More volatility. So we have to keep these things in mind. When we want to include different asset classes, their behavior, their typical characteristics, risk and return potentials, things like that. So mean variance framework was originally developed by this person who won Nobel Prize, Harry Markovich, in 1952, long time ago, right?
Mhm.
75 years almost. It has been extended, made more useful, more practical. But the basic idea is very powerful. He showed us the way. So it is based on some assumptions. One of them is investors are risk averse. Generally, we want to eliminate risk. right? Generally speaking. At the same time, we want to maximize your wealth, right? It is not possible, but that is our intention, right? We want to. Now, either returns are normally distributed or can be transformed to the distribution, or investors are interested only in mean and variance. So the bell curve, it is talking about the normal distribution that in our methodology, we can use this. If we know the mean and variance, we can find out the range. Remember, within plus minus 3 standard deviations, almost 99% of the observations are expected to fall. So we can find out some level of confidence if we know the mean and variance of our distribution. But again, it is an assumption. Historical statistical analysis indicate that historical returns exhibit fatter tails. Actually, what happens in reality, tails are fatter. Maybe this is too extreme. So these are standard deviations, right? And these are the probabilities, right? On this axis. So this has more probability under the blue curve than the black curve, right? They're fatter. So that basically means really bad and really good things happen more frequently than suggested by normal distribution. Okay. So when we think about an investment, we assume that investors make decision based on a utility function that maps wealth to their subjective assessment of the utility. For example, let's say talking about myself, how much utility I think I will get if I have, or if I reach $1 million, let's say, net worth. Now, how much I will get if I get 1.5 million, 2 million, right? So one is wealth, of course, in monetary terms, right? Utility is mental satisfaction and other kinds of satisfaction, right? So generally speaking, higher the wealth, higher the utility. And letting W denote the wealth, U, investors' utility function, we can write this formally as, this is the objective we have to maximize. Max means maximize the expected utility of our wealth. Now, how do you measure utility? Depends on what function you choose. One of the useful functions is CRRA. Just wanted to mention, constant relative risk aversion utility function is one of the simplest and most useful utility functions, okay? We'll go there. So this is how we quantify utility from wealth. And generally speaking, it has a marginal utility behavior. Meaning, yes, this is your wealth on the x-axis, on the y-axis is utility. So as wealth increases, utility increases, but at a decreasing rate. You can think of it as, let's say you are very thirsty for water. The first glass of water you'll enjoy very much. After that, you still are thirsty, you'll get little more utility, but that will decrease. So that is what it means by marginal utility. Okay. So I will not bore you with too much details, but these are just some fundamental ideas. And that curvature you saw reflects investors' risk aversion or willingness to take risk. The coefficient of relative risk aversion is a highly useful measure of risk aversion. Is defined by negative percent change in marginal utility divided by percent change in wealth. So what that basically means, so that is your wealth, that is your utility. And if you calculate the percent change in utility, so that means, let's say this is your wealth A, this is your wealth B, and let's say this is your wealth C. At wealth A, this is your utility. At wealth B, this is your utility. Now, if you take the slope or percentage change, this is much steeper than this tangent. So as a result of that, when you calculate the percent change in marginal utility, it is negative, meaning, so this marginal utility is lower than this marginal utility. So when you move from this point to any point after that, you gain lower utility. So when you calculate the percent change in marginal utility, it is negative. So in other words, it also means if you get more utility, you will get, yes, little more utility. If you get more wealth, you'll get little more utility. But if you lose the same amount of wealth, you will actually experience more extreme pain. You understand what I'm saying? When you go up, let's say your wealth increases by $100,000, your utility increases by, let's say, by some amount, X, let's say. But then, if you lose $100,000, then you will lose utility by variable Y. Y is greater than X. So your pain is stronger. And that is why this curvature, right? And the more extreme the curvature is, more risk averse you are. And that is why it is saying the higher the RRA, the more risk averse the investor is. For example, if you have this utility curve, it is person specific, right? So you will have more risk aversion. Okay. So we talked about wealth, and then we talked about utility, because yes, I have money, but how do I get utility from my money? That's why we need an utility function so that we can measure that is how much utility we can get from my well. Now let's talk about some return calculation. So this is how we calculate gross return, isn't that right? P is the price, I means say asset or security, T is at the end of time T. And this one is at the end of time T minus 1. So if T is day, let's say this is 2nd of January, this is 3rd of January. If it is month, this is, let's say 31st January, 28th February, right? An example. And this is how we calculate gross return. And you also have heard continuously compounded return, right? So continuously compounded return is just the natural log of gross return. And we will work with, nobody knows what will be the future price, so we have to work with forecasted or expected prices. And then we will use natural log of returns to keep our math simple. So this is our gross return, and we calculated continuously compounded return, and then we forecasted. So this is expected continuously compounded return, which is alpha I. Expected continuously compounded return. Again, I means just any asset. It could be from equity as an asset class, or it could be from IBM as an example of equity. And this is the adjustment, which is the variance of continuously compounded return. They look very similar, but note here it is natural log of expected gross return. This is expected value of continuously compounded return. So because we have to work with this continuously compounded return, because continuously compounded return are easy to work with. You can add them. You have probably heard this phrase. Natural log is additive. You can add them. But gross return, you cannot. But because they are not the same, we have to adjust this with this factor. So this is our alpha. This is the adjustment factor. And this will be our return for each asset class in our example. So this is our return. But first we will calculate natural log of returns. And then we have to adjust with the variance of those returns. We'll see that in the Excel. And only then we can find out natural log of expected gross return. So let's go ahead and download this Excel file. Dava, you can see the slide now only, right?
Yes.
Okay, just making sure. Because I'll be working on Excel now, so it will be probably easier for you to follow. So let's download this. If you see these, just break all. Okay, so what we are going to do, we'll go to returns template. So what we are going to do, RT is our natural log.
Here we go.
Hmm?
Where should we go?
So returns template. So these are in descending order, right? So to calculate our continuously compounded return, we need natural log of this price divided by this price. So this is the formula you saw, right? Is everyone good? No. So ln and then yeah. So ln means natural log. And I'm going to just pull it down to the last observation, except the last row. So you don't need this last row.
We stop at the second to last.
Up to second to last. Okay. Now, so this is our gross return. So what I'm going to do, this divided by this minus 1. Hmm?
See.
So basically, this is the same thing as how you calculate return. Last price minus previous price divided by previous price, right? This is just another way. You've probably seen this way more often than the previous way, right? So today's price minus previous day's price divided by previous day's price. So that is our return. That is how we calculate return, right? Now, I'll just double click on this so that it fills up entirely.
Just the formula again, please.
This one? Yeah.
Minus.
Yeah.
And pull it down.
Yeah, just you can just double click on this corner.
Okay.
It should populate entirely.
Okay.
Did it?
Yeah.
Okay. Now, here I'll count the number of observations I have. average standard deviation
The observation. The observation, what's the formula for the observation?
Okay. This one,
Yeah,
count.
just count all.
Mhm. Yeah.
So,
Sorry,
1097?
Yeah.
Okay. Rich. Six. Standard deviation.
yes. You forgot your laptop. Bring your laptop every class. Okay,
Usually I will write down, I will redo it at home.
home. It will get more complicated. We are going to use solver and other things, so you'll have a hard time.
Could you please show the formula for RT? Where did you get the numbers?
Yeah, sure. Just 1 second. You're good here, Edward?
Yes, standard deviation. Yeah, 5.39.
Yes. So you're talking about this, right?
Yeah, I'm just dividing, right?
Yes.
Uh,
Natural log C8 over C9.
Hmm.
Max is just max. You can see the formula here too, not from here.
It's 5.46.
Yes, and then mean, same way. So max finds out the maximum value, mean the minimum value, right? Okay. Now all we have to do, highlight this, pull across. Right? Now see the difference in mean. Spatially. They're very different, right? 0.9 and 0.76. So that is what we are talking about. The continuously compound return is not the same as gross return. So, but if we make some adjustments following that formula, What was the formula? This. We can get to correct value with this adjustment. So this is our continuously compounded return, or in other words, natural log, right? Of gross prices, or gross return. And all we have to do is plus half times the variance. Okay, let's do that. See, I think they have already calculated it here, this mu calculation. E2, which is this, plus half, which is 0.5, times this standard deviation squared. You see this here, right? Which is 0.9, very close to 0.91. Right?
Yeah.
So we have to use this because we will be working with continuously compounded return. Because first of all, they're easy to work with. We can sum them to find out a holding period return. Second of all, they are more well-behaved in terms of distribution. They follow normal distribution more closely than gross return. Okay. So is everyone good so far? To go to the most important formula here. If we want to, so we agreed that yes, an investor has wealth, but we need a way to determine or quantify the utility from that wealth. And we use that, we use a utility function for that. Now, we will maximize utility if we can maximize this formula. So this is mu, that mu calculation you showed, you saw. W is wealth minus lambda is risk aversion coefficient. Sigma is squared of our wealth times T. T is the holding period. First, we'll work with one period, for example, 1 year. And then we will extend it over multiple periods, let's say 20 years. Okay. So that is our objective function. So we want to construct our portfolio in a way our utility is maximized. And utility will be maximized if we can maximize that function, the value of that function, right? But there are some constraints though. What are those constraints? The sum of the weights have to equal to 1, isn't that right? If you invest 50, if you have 2 assets in the portfolio, 50% goes to stock, and the other asset is bond, it has to be 50%, right? And if you have, let's say, 3 asset classes, one is 50%, another is 40%, the remaining has to 10%. So in other words, your portfolio has to be fully invested. So that is our one constraint. Second constraint is, sometimes we will use that only long only constraint, which means we cannot short, right? We cannot short, we can only follow long investment, meaning we will gain if the share price increases in terms of stock. So that is what long investment is, right? So In other words, we will, okay, so that is for mean variance frontier. Actually, maybe I can explain a little more here. Before we go to the optimal portfolio meaning optimal for a particular investor. And that particular investor has a specific risk aversion, which is lambda. That's why you saw that lambda in that formula, right? So that is for the optimal portfolio. So this is the lambda. And if the risk aversion or lambda is higher, investor is more risk averse. So that's why this return is penalized by a larger number. So utility goes down. So that is how to get the intuition from this formula. Again, this is lambda. Lambda is a proxy or is a measure for risk aversion. Higher the risk aversion, more risk averse the investor is, right? So for a higher risk aversion coefficient, this value will be penalized by larger amount, right? So that is for optimal portfolio. But before we go to the optimal portfolio also, let's get back to the efficient frontier for a little bit of time. So MV frontier, meaning mean variance frontier, is a set of portfolios with the lowest risk. And then we have efficient frontier. I'll actually discuss more when I actually solve a problem. Once the efficient frontier is identified, the investor can identify the portfolio with the risk that best fits with our preferences. Okay, what all those mean? Let us work on this EF template in the same Excel.
If we just worked on.
Yeah, same Excel. But we are going to go to this worksheet, EF template. EF means efficient frontier. Now, we will work on a 2 asset portfolio. One is stock, another is bond. Now, all our underlying data are here. These are our arithmetic return. These are our logarithmic return, and we are going to use this side of the data. Now, first, mean means we have to minimize what? We have to minimize the risk of our portfolio. And in this cell, it will be equal to, we are going to calculate our portfolio risk in this cell. So we are just making a cell reference to our sigma, our portfolio risk. That's not bad, okay. Now, of course, we'll use solver to find out the optimal weights. But for now, we'll help solver to initialize some values. So 0.5, 0.5. Now, this is our budget constraint, right? All the weights need to sum to 1. So that basically means sum of these weights. So sum of these weights equal to how much?
1.
1. Okay. Now, in this case, what we are going to do we are going to find out portfolio that generates a specific rate of return, but minimizes risk. So we want to find out the portfolio with the lowest risk for a given rate of return. And we will do that for each of these, except for MVP, and I'll discuss this. So, for now, so this return, we will calculate here this. So this will be the calculated return by solver using this weight. And this needs to equal to, let's say we want to solve for this first target return, 13%. So you want 13% return, and this standard deviation has to be minimized. Now let's come back here. So before you can calculate this, this is the same mu and sigma that you saw in the on the slide. Edward, did I lose you somewhere?
Yeah.
Where?
The mean is the mean.
Here,
The 0.
this.
Yes. Okay.
Mhm.
What about it was 10%?
This one is from here.
Okay.
Yeah. Now let's come back here under S&P 500 on this row, alpha. This is a continuously compounded return, right? So I'll enter equal, go to data. So that is my S&P 500. This is my alpha.
0.8.
So you enter equal sign and then go to this worksheet
Yeah.
and highlight this cell
Oh.
and hit enter. Now we can pull down, that will bring up our standard deviation, because standard deviation is just below this. Similarly, we can find out bond. Bond is this. This is our alpha. Is everyone good so far? Java, you're good?
Yeah.
Okay. So now this mu, which is our alpha plus half, that means 0.5 times our standard deviation squared. Restaurant, it is small, we can make it bigger. You're good?
Yeah. This 0.5.
Yes, Edward?
So it was 0.5 times.
Point, yeah, so this sigma. Rick, you're good? Yeah.
Square.
Squared, yeah. You good?
Yeah.
Okay. And then you just pull it across, yes. Now, we can calculate our return, right? Because we have the weights and we have the returns. So we can use sum product formula. Sum product, this and this. Everyone knows what sum product does, right? Yeah, sure. So sum product is basically, for example, it is the same as if I want to take this times this plus times this. So we have two arrays, right? And you don't see probably the value of sum product here because we have only two terms, but when you have a long array, it's very, very powerful. And we'll use that actually for 5 assets. You understood it? Yeah, okay. So either way you can do, you can use sum product or you can use this. For now, it doesn't matter because we have only 2 stocks, 2 assets.
Different number.
Some product.
You get different number?
Yeah.
Yeah, I have 0.1708
Yeah.
when I use the sum product.
Okay. Let's try again. Product. Did you choose this way?
No.
Yeah, so you have to choose the array correctly. Yeah.
Okay. It's another me.
You get the same number? Yeah, close. Yeah. So we have more fun waiting actually, if you like this formula. So now, before we can calculate this, we need correlation. So rho means correlation, right? So first of all, between S&P 500 and S&P 500, what should be the correlation? 1, right? But we, instead of typing, we'll just keep the formatting. So I'll go to data, S&P 500 under S&P 500, 1, right? Okay, and then S&P 500 and T-bond, which is this one, right? This is correlation matrix. So in this case, we are using correlation. Math is simpler for 2 asset portfolio. Next, when we work on a 5 asset, we will use covariance, which will be this table. Just wanted to make sure, be careful of that, okay? Yes.
So on the, I think there's not gonna be any problem, but on the correlation between the S&P 500 and T-bond, can I post the data as a I-14 on data page?
Yes. Yes, you can. I see what you mean. Yeah.
Okay, I just wanna make it
Yeah,
clear,
with
so,
the full matrix. Yes.
okay.
This one, right?
No,
This one.
yeah.
Yeah.
Got it.
Yeah. Yes, this works perfectly.
Okay,
And for T-bond versus T-bond, it will be 1, but I'll just select from here.
Could you please show one more time? How did you get 1? Because mine is showing like 0.0349.
Can you say it louder?
Could you please show one more time? How did you get the 1? Like,
This one or this one?
no, yeah, this one.
This one,
I
yes.
did the same,
Yes.
but
So inter-equal. So
Mhm.
what we are going to do, we are going to find out the correlation between S&P 500 and S&P 500.
Mhm.
So we will go to data. So this is our S&P 500
Yes, S&P.
and this is under S&P 500. So this is the
Oh.
intersection.
Yeah.
I choose the second one, covariance. Oh,
Yeah,
sorry.
now use correlation.
Yeah, yeah.
So rho means correlation. We are going to use correlation now.
Mm-hmm. Got it. Thank you.
Yeah. So similarly, you got this one? You can also directly type, just like this.
Yeah, I got it.
Okay. What about this one?
T1. One. Yeah, I got it.
So now it's a little longer formula. SQRT, what does it do? Square root, very good. Because we want a standard deviation. Within the parenthesis, we will calculate variance of two assets. And this is the formula for variance we are going to use.
Yeah.
So this is the weight in our stock asset squared. Standard deviation stock squared plus weight bond squared. Standard deviation bond squared plus 2 weight stock weight bond sigma stock sigma bond and correlation coefficient, right? So SQRT open parenthesis. First, this is our weight squared.
One,
Mhm.
so 500.
and times this way, this standard deviation squared. So you will be allowed formula sheet on the test. So try to understand which formulas we are using in which case. Okay. For example, the formula I showed you, right? We are using here. So, and then plus our weight of bond squared times, sorry, standard deviation of bond squared plus 2 times weight stock times weight bond times sigma stock times sigma bond times correlation coefficient, close. Okay. You're stuck. So F12 squared, F26 squared plus G12, G26 plus, yes, 2 times this times G12 times this times the next one times the correlation coefficient This one, 0.8. Close. Yeah, I know. Hit enter. Is that how much you got?
0.5.
No?
Think so.
0.15.
You did not? SQRT F12 squared, so this is times F26 squared G12. Right, you're good here. You see the G26? Square it.
Okay, G26. Oh,
Yeah.
okay.
Hit enter. There you go.
Okay.
Yeah. So now we are going to use Solver. Solver is a nice tool built in Excel, right? To optimize. So data. So data. So if you don't have Solver, what you have to do, go to File. And then More. Options. And then add-ins. And then you will see Solver. Here. And OK.
Go to File.
Okay. Not yet here. Let me try again. Okay, so you have to options, add-ins, go, and then choose Solver. Okay. And push OK.
Add-ins, Solver add-in.
Yeah.
Add-in, Solver add-in.
Yeah, and then go. Highlight Solver. Yeah, and then OK. Go to data. And open the Solver to the right. Yeah. So, is everyone good so far? Okay. So now, data Solver. Go ahead and reset all. So reset all. Now, our objective function is which one? Which cell does include the objective function? What is our objective in this problem now? We want to construct a portfolio, right? So that the return is 13% and risk is minimized. Right? So this is our objective function. You see, it also written objective, right? Minimize this is standard deviation, which comes from here. So this is your objective function. And our argument is minimize. Sometimes it will be maximize. So pay careful attention there too, right? So we want to minimize the standard deviation. So this is our objective function. So when your cursor needs to be here. The solver is not very, very user friendly. So cursor needs to be here and then choose this cell. If you click double, it will pull up double. And then choose mean. So that is our objective. And what do we want solver to do? Changing. So click on this, inside this box, these two weights, right? So we are telling solver, minimize that formula, value of that formula by changing this, but we have some constraints. So add. Our constraint, we have two constraints, right? So they have the same sign. So what we can do, we can select at the same time. And then they have equal, right? So choose an equal sign from here. And in this cell, choose these two cells. So we are telling solver, minimize this by choosing values for these two such that this equals to 1, this equals to this. Right? This is how solver is reading it. Any questions? Me? No. Edward? You're good? Okay. Rick?
Yeah.
Push OK. Now, short cell is allowed, right? We don't have any constraint that they have to be non-negative. So make sure you uncheck this. And then solve. So if you see this, solver found a solution, you're good. Did you find a solution, Edward? So now push OK. Do you have the same numbers?
Where?
Yes. So in here and here. No, I can have a look.
Yes, it's Google Sheets though, I know Excel.
Oh, so does it have solver, Google Sheet?
It says it does.
So can you show me, that's the solver, right?
Yeah, I don't know why it's, now it's all gone. Oh, here we go. Okay. But so, G8. Minimize. Those two.
And variable cells, okay.
Constrained is
E1516, G1516, okay. And then uncheck this one. Okay, now try to solve.
update this one or no?
Selected constraint. No, you're good. Would you like to run a full linearity check? No. So do you have Excel downloaded in
No,
your local drive? You don't, okay. So first of all, you know that you have free access, right? To Excel Office.
I saw that.
Yeah, so download that.
Okay,
So if future. So now here, let's see if we can change the algorithm. So let's try this one. So oh, we have to enter. Okay, so that's still working.
So all satisfied, should I just okay?
Yes,
Yes, okay.
yes, but also check the numbers with mine. They don't match, so something is wrong.
But
So,
why the numbers? I don't understand it.
yeah, so you have to compare this mean with my mean. You have to compare these two weights with my weights. Let me see. Here. Okay. That's good. That's good. Okay. I think, solver G8, F12, G12, E15. Okay. Did you guys get the same numbers as I did? Okay. Let's delete E15, E16. Oh, yeah, I see. This should be just one, you type one. Now try,
Data,
yeah, solver and run.
just one, just one.
Now check. 0.2410, right?
Okay.
And also check the weights. Any luck there? Great,
No, it's same,
same,
yeah. But I know how to do it though.
okay. So. What we are going to do now, we are going to copy this. Control C. Paste here. Right click, just the values. Okay, just values. So if you right click on it, you'll see options. This will paste the values, right? Without any formatting errors. Now, this is our mu. So what we are going to do, we are going to calculate this again, sum product. These are our weights, comma. These are our returns, and I will lock this array, close. The second array completely locked. Okay.
Something wrong here.
Something is wrong. So let me see.
Just control this one.
Now copy this. Control C. Go there, right click. And 1, 2, 3. Here we go. And then enter this formula under mu.
Under this one. Some products.
So. You're good?
0.13. 1300.
Same number?
Yeah.
Okay. Now what we are going to do, again, type the standard deviation formula. So this is our weight squared times our return, but now we'll lock it so that we can pull down. So lock F24. Squared plus
C2.
wait, this squared times this log squared plus 2 times this sigma log, this sigma log times correlation coefficient log close. So we are locking these cells. We are not locking these two. So that we can pull down.
Far from it. See clearly, I said I'm too far from it.
Too far from it, let's see if I can make it bigger for you.
In 10 square. It's 9.
I can make it bigger, but then you will not be able to see this.
Yeah.
So if you are done, go ahead and try to solve for the portfolio with return of 12%. So all you have to do, instead of referring to cell 13%, refer to 12% and solve.
I get the stuff on, I got it selling.
You got it?
I just need to get, this, I'm waiting for the solar first.
You saw what is working?
Yeah.
Oh, nice. Go from Google Sheet.
No, I got Excel now.
Oh, okay. Oh, that was quick. You downloaded it?
Yeah.
Okay. I wrote you're good.
2.144. 5, okay.
You're good?
Yeah.
So let's try one more here so that to make sure our setup is working. So you see this 13%, right? Instead of 13, enter equal to, let's say, 12%. Hit enter and then solve. You don't have to make any changes. Solve. If you read this, we are good. Did you get the same?
Just 12, right?
Mhm.
Okay.
Yeah, so copy this. So we have to keep doing this for each of them. But in the interest of time, I'll just give you the numbers, right? These are the numbers.
One in silver though.
For which one? For the
Uh,
first one?
Yeah.
Okay.
1.14.
Let's see. You have minimized, okay. And then
These cells.
these two cells, okay, F12, G12. And 15, 15, 16, 16, okay. Now, close this. You have run this already, right?
Mhm.
Okay, so close this. Let me see.
It gives me 0.14.
You see 0.14 we have 0.1. Okay. Let's see if this setup is correct. This should be 1, right? So this is the sum of the weights, right?
Yeah.
So that should be just 1. And this is from I10. Okay, now from
2.4.
uh,
2.4.
you should get
Oh, this is 0.13, it says.
Yeah, so these are the returns. You can now compare the return and standard deviation. So yeah, you're right, 0.1300, 0.1445. Oh, but that is not correct.
No. Why is that one wrong?
Let's see. Just one thing, I want to check, I got the right numbers. Point, no. Your one is right,
My one is right?
yeah, so. Did everyone get this number?
0.4.
I think
You got this? So let's see, J10.
So I have changed it from from 130 from 13 to 12, and it didn't give the solution.
Say it one more time, Java.
So it was right in the beginning. Then when you said to check it, change from 13 to 12, I've changed it, and it couldn't find a solution.
Yeah, I think the same thing.
So let's see, if we use this two. Here. I did something wrong here, so this is the correct number.
Okay.
So I have a wrong formula here, let's check what happened. J10, F24.
Mhm.
So J10 squared, F24 squared plus K10 squared times G24 squared plus 2 times J10 K10. So I chose F24, this should be 26. Okay.
Now that one is wrong, right?
Mhm.
When
Which
you-
one? This one?
It says 0.13 is equal to 0.12 in yellow.
So that was in my second iteration, which I did not run yet.
Okay.
I've run mine already.
So if you have run,
Now I have the same as you.
okay, yeah, you are good actually.
Okay.
Yeah, you are correct. I made a mistake here. I did not choose the correct cells. So is everyone good so far? No? Huh? Which one you got wrong?
The last one you said you made a mistake on it.
Yeah, do you have the same number now here? 0.24?
We have the one.
Okay, so let me check.
Let's try that and then I run.
No, yeah, you are right.
On this one?
Yeah, you were right in following me. I made a mistake, so it should be 26.
This one.
You go.
So this one's
This
right?
formula.
This top.
Yeah, you don't worry about this. We'll change that.
Use running that solver and pasting this over to here. So you just copying that and pasting it. And then out here, he's got that. This is some product of this way. This one right here.
That's that one is some product from these.
Using these ones.
So
Yeah.
go ahead and pull down, check if you get the same numbers.
These two.
And Java, you are good, right?
If you go back on that. and hit
I got the same number, but the numbers in variables,
This one.
they have changed.
you open up on it.
Sorry, you got the same numbers, but
G24. Hit
The
F.
numbers in variables section, they totally change it. They become like
so yeah, that's okay.
This one too.
I made some changes here,
And then now.
So,
you can paste them.
but do you get the same numbers here?
Let's see.
That way.
yeah.
Okay, that's what is
This one
important.
too, or
No.
no?
Easy, this. He's
And-
got all the stuff up here.
Now copy this, paste here.
So you'd have to. Hang on, let me get this. This one.
Do you get the same numbers?
Delete it until you put something there, so if you put just like a 1 and a 2 there, it would.
I see. Okay.
And then this big old. I'm sorry. This is that big.
and then pull down.
Where?
Check if you get the same numbers.
Use that way.
Thank you, good.
Yeah.
Edward,
Okay.
Okay.
F26.
check. Do you
Could
have
please
this,
show
did you
one more
copy these
time the
numbers?
formulas for stock and bond, starting from 12,
Something
11,
different.
35.
I don't know if I made a mistake in here because just change this 12.
Yeah, don't forget about that. Just go ahead and copy paste those numbers from the chart.
This one.
So all these numbers you see, that table? Yeah, after 2942, you have 1.1161, right? Next to 12%. So this, go ahead and fill that, but not here. So fill up
F26.
these two sections. Yeah.
Okay. Times G26.
So for example, what I mean, after here, right?
That one.
So you will have to
And
just
times
type this
G26.
number.
Just to type
One,
it.
yeah, 1, 6.
Let me just
One.
type them, okay.
Yeah, so the reason is, yes, you have to solve it
And
by yourself
it's- it'll
following.
be the same
what
thing
you
as soon
did
as you get
for the
that
first row, right?
there, start
But in the
counting.
interest of
Why don't
time,
you get
I
the-
just
why don't you
gave
get
you
those
the numbers.
fast?
Solver would have
I already
given you,
remember.
For those,
right?
for all those.
And then
And then.
type only
or
these two
he's got 'em
columns.
up there,
except for
he just dropped it.
And then in these two
So
columns,
you'd
you
have to
pull
write
down the
it, so
form.
You would adjust this one.
But go ahead, first of all,
You would
type
put it,
the numbers.
And then do solver.
it's- But he dropped it all in up there, so you could.
Yeah, but don't you wanna do solver?
Yeah, you would, so like you would adjust where that is. And then hit solver. And solve. And it would give you the weight that you would then drop in. But you'd have to do it for everyone. You just- So that's why he dropped it in, just.
Java, you were saying something?
I know, I got it.
You got it? Okay.
Mhm.
So again, what I did here, right? We just solved this for this one, right? And then solver gave us these numbers. And I just gave you these numbers. When you do it yourself, by yourself, solver will give you these numbers. In the interest of time, I just gave you the solver's numbers. And then this, you have formula, right? So that you can just pull down. Pull down. Now, just to check, let's try to solve one more. Let's say for 12%. And then go to solver. Solve. So solver found a solution. So this should match with exactly this, right? Does it answer all questions?
Press solve, and then.
Sorry, say it again.
I got it.
You got it?
Yeah.
Okay. So now, yeah, go ahead and type these numbers and then pull down these two formulas. So up to this, and then you will copy again, paste here, and then pull down again. Yes,
So is there any reason why the weight of the stock bond is like negative? Or like
Short,
past
yeah.
one?
sorry,
So like the weight, you said easily 50-50 add up to equal to 1. I mean, that's kind of understandable, like 50% stock, 50% bond.
Right.
but How come a weight of a stock would be 1.29 and then bond be negative?
so
That's
that
confusing.
when you add them two is equal to 1.
But how does that?
So that means you are actually borrowing this much money by selling bond. Let's say you want to invest in these two ratios, right?
Mhm.
You'll invest 111% roughly in the stock, but where does the 11% come from? You borrowed. So that's why this negative means short sale. So short sale is allowed. So you can take,
So it means like, but you just started So you borrow bond to sell? I am confused about that.
You sell bond.
You sell bond. So it means
Selling
like
bond means
already-
borrowing money, right?
So you own bond already? No.
I think he's saying is if
Huh?
you create a bond and sell it.
Yeah,
Okay.
you can, if you are the company, you can create a bond, but there is already bonds being traded. You can sell bond.
So
When you
that's one is for, so it's mean like, look like
Mhm.
we, in, management, like, and then that's one is for the company
So
invest.
probably easier way to think of it as, let's say you have only $100 million to invest, right?
Mm.
Now, but you want to invest how much? I will calculate only up to 2 decimal point,
Okay.
112%.
Mhm.
Meaning I was to actually invest in the equity 112 million, right? But I have only 100 million. Where does the 12 million come from?
So
You borrow. To borrow, one of the ways is you sell bond.
I see.
So when you sell bond, that means it is a short position. Right? Now, it doesn't have to be bond. Let's say, so it is stock, it is bond minus 12 million bond, and this is plus 112 million stock, right? It doesn't have to be bond. You can say IBM 112 million, but I have only cash 100 million. Where does the 12 million come from? I sell, let's say, Microsoft. $12 million. So this negative means the short position in the Microsoft. Why? Share price, Microsoft goes up, you lose money. Right? So the details are much more complicated. For example, when you take a short position, you cannot immediately, you don't have access to the proceeds immediately. Second, you have to pay interest. So there are some complexities, but the idea is you can take a short position. So remember, in this objective, short sell is allowed, one. Second is we want to minimize the standard deviation. So to minimize the standard deviation, if you look into this formula, standard deviation. So these cannot be negative, right? These are square.
Yeah.
The only thing that can be negative is your
Correction.
correlation can be negative. Your
Your way.
weights can be negative, right? So let's say if we focus on the weights, correlation is not changing here, right? So if it is negative, our risk will be minimized, right? So short position is a way to diversification. Another way is, of course, if you can find out assets which have lower correlation. Make sense? So this is an ideal situation, everybody can short sell. But in many portfolios, short sell is not allowed. For example, in most of the retirement portfolios, for many individuals, shorting is not allowed. I remember I mentioned in the last class that the student managed investment fund we have, shorting is not allowed, right? So there are some restrictions. For example, derivatives can be considered as an asset class, but not all portfolio can trade derivatives, right? So minus means you borrow money. Now you can sell bond. In this case, why bond? We have the other asset as bond, right? Any questions? No, okay. So now next is, we didn't do anything here, right? Now what is this? MVP. MVP means
Market value price.
market value price. Okay, good try. But far from it.
That's in, mutual fund.
This is minimum variance portfolio. Minimum variance portfolio. What does it mean? So far what we have done, we found out how to construct portfolios in the most optimal way to achieve a target return. And what was the most optimal way? In our cases, we wanted to minimize risk. But we also wanted to achieve a specific rate of return. But now, when we are focusing on minimum variance portfolio, we don't care about the return. We are saying, I just want to minimize my risk. I don't care if I have negative return. I know it is not possible. Nobody will have that kind of objective, right? But there is another reason why we want to focus on that. I'll come to that. So, but that is the idea about minimum variance portfolio. All we want to do is minimize the risk. So what do you think? How do we have to adjust our solver setup to find out the weights? That means these for the minimum variance portfolio. What changes we have to make? So in this setup, what did we do? We said, hey, solver, minimize the value of this function by changing these two with the constraint, yes, by changing these two weights with the constraint that our position has to be 100% invested. Our portfolio has to be 100% invested. And our return needs to be 12% for this portfolio, 13% for this portfolio, right? So we have individual iteration of solver for each of the different portfolios. Now we are saying we don't care about return. So how do we have to change our solver setup? So we don't care about our returns, meaning that is not a constraint anymore. We just will get rid of that constraint. Right? We'll just get rid of that constraint. I know you still have some unanswered questions, but let me finish that. I'll try to connect everything, the objective of this exercise. So I'll go to solver. Edward, you're good?
It seems like that. It seems I'm good.
Okay, all right. So solver, you can also meet me during office hours or other times. So here, I'm going to click on this and then delete. Now our constraint will be only the budget constraint, means weights needs to equal to 1. Edward, you can do this. This one doesn't have any relationship with the others.
Okay.
Yeah.
So we go to data solver, right?
Yeah, so delete this constraint. So for example, when you click solver, you had constraints, right?
Yeah.
So select, push on this, and then delete,
Nice.
Okay.
and then add, choose this, and then equal to this, and push OK. Push OK. Now all we have to do, solve. Did you get this? Push OK. So these are correct. I'll just copy, paste as values. And then here, I'm going to pull down, but without formatting. Preston, you have a question? No? Okay. Tang? No. Okay. Rick?
I got it.
You got it. Okay. Now, now here, this will be our two extreme. We will invest 100% in a stock, so it will be 0% in the bond. And this will be 0% in the bond, 1%. Actually, I said the opposite way. 100% in the bond and 100% in the stock. And these are the two portfolios. And you see this curvature curve. This is what I asked you in the beginning of the class. Do you remember the mean variance framework? So this is your standard deviation. This is your return. Not a good drawer, but you understand. This is what I'm trying to draw. Now, this entire frontier, it is called a frontier. It is called mean variance frontier. Why? We have mean return. We have standard. We don't have the variance, but it is just a matter of practice. Instead of saying mean standard deviation, we say mean variance. But when we use in this framework, we actually use the standard deviation. Okay. So mean variance. It is not a straight line, right? It is a curve. So MV frontier means mean variance frontier. It is a set of portfolios with the lowest risk, and that is exactly what we did. Isn't that right? We minimized risk for a given level of return. And all these portfolios that you saw in the Excel, these are plotted on this line, right? All these portfolios are plotted on this line. So this is based on this mu, this is standard deviation. This standard deviation is on this axis and mu is on this axis. Okay, so we got the mean variance framework. But are these portfolios efficient? Think about it. So of course, standard deviation is increasing that way, right? So as you take more risk, you can earn higher return, right? But let's say I pick up a specific point. I pick up this is how much standard deviation I can tolerate, let's say. Now, if you draw a perpendicular line, what do you see? How many portfolios are there? 2, exactly. One is here, another is there. If you are a rational investor, which portfolio will you choose? Explain.
Higher return and the same risk.
Exactly, exactly, right? So you can draw an infinite number of lines. For each portfolio on this side of the frontier, there is another portfolio with the same risk but higher return. So that's why this upper portion is called efficient frontier. The entire thing is called minimum variance frontier. Upper portion is where we are interested in. That is called efficient frontier. It's a set of portfolios with the highest return for a given level of risk, right? But where does this start? It starts at the minimum variance portfolio, MVP, and upward. So I am going to, so this should be MVP. I will rewrite this MVP. And I will copy these, Control C, paste as value. And then pull down. So this is our minimum variance portfolio. If you are willing to take any more risk, you should take a portfolio on the efficient frontier. If you're a rational investor, right? So this is what it is saying here. The efficient frontier consists of the portfolios where mu target is greater than or equal to mu MVP. So on the upper portion of the frontier.
But why would you ever take the lower one?
You will not.
Yeah, right.
Yeah.
Same risk.
Same risk, but higher return. So when we plotted all different possibilities, right? So this entire curve consists of an infinite number of portfolios. Each point reflects a particular set of weights for a stock and bond. So this is our frontier. My question is, which one should we invest in, right? Because on this frontier, for each portfolio, there is another portfolio which is outperforming. We will totally ignore this side of the curve. We'll always invest in one of those portfolios. Now, which one is this? That is the second part of our exercise. Depends on your risk aversion. That is the reason we talked about risk aversion. This applies to the entire universe. So far we used only one stock and one bond, right? Think about when you have hundreds and thousands of stocks and bonds, right? And these are only just asset category. So again, so what we did here, we tried to plot our total opportunity set. Total opportunity set. And then we also were able to discard one part of it because these are not rational choices. Now, still we have a number of portfolios to choose from. Which one should we choose? Depends on our risk aversion. So let's take 5 minutes break. Okay.
Doctor, why don't we take the class with computer?
Huh?
Why don't we study at the class with the computer?
We are going there when we use
Bloomberg.
You're talking about Bloomberg terminals?
I mean, like, because we use a lot of Excel, why don't you teach in the class down there, they have the computer.
Classroom is not fixed, right? Depends on availability.
I see.
Yeah, that's one thing. I can check if that room will be If that one is available, but
Yeah, because like,
choosing classroom doesn't depend on me, right? It is just assigned to me, but I can check if you think will be useful. Second is Bloomberg. Yeah, Bloomberg Lab will go to there when we use Bloomberg. Yeah.
do we go to Bloomberg today? Because we have Bloomberg exercise next week.
That was my plan, but we couldn't progress as much. Actually, we have to reschedule our homework too.
Oh,
So we
okay.
have to delay.
Em ơi, em gửi bài cho chị được không?
Được.
Không, cuối giờ em gửi cũng được. Chắc giúp thầy thêm một cái nữa.
Ok.
Cảm ơn em.
With what question?
It's okay.
It's okay?
Yeah,
You are the same company?
yes.
How is work for you, me?
I'm tired all the time. Yeah.
What about you, Rick? A lot of work?
No,
No? Okay,
I work for the golf team here.
okay,
I'm grad assistant.
okay. Yeah. This is probably not as hectic.
No.
What about you, Java? Oh, right.
Yeah, I'm here.
Okay. So how is our golf team?
Good.
Good?
Yeah.
Did we win any? I don't know much about golf, actually.
Last year,
Yeah,
we were ranked 5th in America.
fifth in the entire country.
Yeah, and
Seriously?
in Division 2. Yeah, we're good.
Oh, okay.
But just nationals we didn't play well. But this year the team I think we lost our 2 best players.
I see.
but
Like they
we
changed the schools, you mean, or graduated?
graduated.
I
Yeah,
see.
but we got 2 or 3 new ones. They're pretty good.
Okay.
They just need some time, I think.
Okay.
I think next semester we can be really good. They're good, but
Okay.
if you compare them with the 2 that left, then yeah.
But they need some time to.
Yeah.
Yeah, I see. And do you like yourself teach them, coach them?
Yeah.
Okay,
I used to play college golf and now I'm just coaching.
okay. Which college?
Rider University
Ryder,
in New Jersey.
New Jersey, okay. New Jersey to Oklahoma, long way, right?
Yeah.
You have family there, here?
No, just friends in New Jersey.
Just friends, okay.
No, my family's in Europe.
New York, okay. Preston, you grew up in Oklahoma, right?
I grew up in Texas.
Oh, okay. Which part?
It's a town called Abilene, Texas.
Oh, the Stargate project?
Yes.
Yeah.
It's huge.
Yeah,
Yeah, the Abilene is changing a lot, right?
yes.
Because I see all on YouTube and
Yeah, changing a
a
lot.
lot.
Yeah.
Okay. Your houses are going to be probably like $1 million now very soon, right? Your parents' houses.
Yeah, parents.
Yeah. Okay. Abilene. Nice. How far is Abilene from here?
1.5 hours. It's not too bad.
Is it like in the direction of Dallas or? No,
Not
Not
exactly.
okay.
Where are you from?
Bangladesh,
Bangladesh?
yeah,
When did you come here?
2012,
Why?
student,
Oh,
studying, yeah.
And then green card?
Studied, worked, green card, yeah.
Oh, you got an H1B?
First H1B and then green card
Where?
through work. From my previous school.
I gave
Uh,
H1B.
yeah.
You worked at the school? Teaching?
Yeah,
Uh,
very professor, yeah. So this is my second job, full-time job. So I joined at UCO 2 years ago.
So
It's
you
my-
got, first you did 3 years H1B, right? And then another 3 years,
Yes,
And
in
then-
total 6 years.
and then green card.
Yeah, it's a long time.
Yeah.
Actually. I was a student for 6 years, 2 years my master's, 4 years PhD, 4 years for my H1B
What is the other
green
job?
card. So it took me almost 11 years, I believe.
What is the other job?
Other job?
Uh-huh.
What do you mean? Oh, the professor, another school,
Oh, another school. Which one?
Westminster College, Fulton, Missouri.
It's online.
No, it's a very good private school.
Oh, you drive there every week?
Yeah, like UCO, not there.
Oh, but it's for us previous job.
Previous job.
Oh, okay, okay.
Yeah. Oh, I see.
I thought you
Am
had
I
two,
lucky?
yeah.
Oh, no, I wish. I wish. Who doesn't want to make more money, right?
Yeah.
Yeah. So, welcome back. So. Now, we are going to find an optimal portfolio. Okay. So we are going to use the OP template. Oh, me is not here. The optimal portfolio, our objective function is this for one period. Mu W, so the portfolio return minus lambda risk aversion coefficient times sigma squared. So we have to now, because it is optimal portfolio, in our definition, optimal portfolio means maximize return. But because now we are being investor specific, we have to account for that particular investor risk aversion, right? And that is reflected by this lambda I was talking about previously. So if lambda is high, then you will subtract a higher value from this return. So this will be lower, right? That is how it works. So let's try to implement that. So here, what we have to do, we are going to find out the optimal portfolio for investors if his risk aversion coefficient varies like this. So first of all, this lambda I will type, or I can just make a cell reference in this cell equal to, let's say 0.01. So it's a very, very low risk aversion coefficient. So that means he probably doesn't care much about risk. Remember, the higher the value of lambda, more risk averse. Okay. And then we are going to calculate this objective function, which is the same thing as we saw here. So which will be our this mu minus our lambda times our sigma squared. Okay. Now, I'm just going to assume for now 0.5, 0.5. Now, the only one constraint is fully invested portfolio. So sum of the weights equal to 1. So too risky asset and short sales allowed. Now, these are fortunately already given to us, right? So we can skip these two parts. Now, what we can do also, in the interest of time, go to EF template. Copy this, Control C. So they are calculated in the same way. Right click, formulas.
Oh,
So I don't want the formatting to be changed. So right click. Okay. I'll
I
just
can't do
delete this. I don't need this. Is that good? No? So,
if I do copy,
yeah,
it will just copy this.
copy, and then go to
Yeah, we're looking.
right click,
Oh,
and paste and
Okay.
spatial.
oh, here, formulas. I see.
Yeah.
Got it.
Yeah, okay.
Okay.
So go ahead and delete the two. Yes, this is the formula. So, and go ahead and delete the zero. Mhm. So this will be equal to sum and the weights. The weights are, this is stock and bond, yeah. Close. You enter. And then equal to 1. There we go. No, not this way. You have to type 1 here.
Just type.
Yeah, type 1. Yeah, just type 1. Okay. Now, what we are going to do is data, solver, reset all. Now, what is our objective? This one. So when your cursor is here, select this cell, and we want to maximize now, right? Objective is maximizing. Now by changing, click inside these two values. Add, what are our constraints? We have only one, this one. This one needs to equal to that one.
Can you do it one more time?
Hmm?
I think you have to do it one more time.
One more time, yeah. So do you have this?
Yep.
Okay, and then add.
8 or 12, okay.
And then this.
One.
Equal to. Now choose this one. Okay, right? Now short sale is allowed. I will uncheck this. So. Solver found a solution. We are good. Let me check.
To solve no specific,
Yeah.
not specified.
So
I have the graph,
you have what?
because I have the graph, but they're saying. So, I have this one.
Problem to solve not specified. Okay, so yeah, you did not specify, you specified this, but changing variable. The solution, check these numbers with my. Yeah,
Good. Yeah.
Is that the right number?
let me check. Yes. Yes. Yeah, look.
Do it wrong.
Oh, uncheck them. Because short selling is.
Oh, yeah.
Did it work?
That makes sense.
So now. What we have to do, we are going to copy this. Paste as values. So these will be calculated here. Now let us solve for one more. Let's say this one.
So you're gonna paste as a 1, 2, 3, right?
1, 2, 3.
Paste as values.
Oh, yeah, as values, yes.
Okay.
Yeah. Yeah. And this one, let's say we choose 3. And then solve. Let's see if it is working. Solver found a solution. 10537. Yes, it's correct. So now I'll give you, the interest of time, I'll just give you all these weights. Edward, you were saying something?
Yeah, so solve and just solve everything for this one, just to solve, right? All right.
Yeah, go ahead and solve, see if you get the same numbers. Yeah,
Lambda still have 0.01.
sorry,
Lambda still have the 0.01.
yeah, lambda change that to equal to 3. Okay. And then solve again.
This changes here.
That's okay. Yeah,
Oh, okay.
it just means it is not wide enough.
Okay.
Yeah.
In the previous one, that's what I was just so.
Mhm.
Sorry to.
0537, yeah, you're good. So. Yeah, so I was saying, I'll just give you the numbers. Java, you're good?
I have the same numbers, but I'm not getting the same number in when I change the to 3.
When you change the what?
The 3. I chose 3, but
So go ahead and solve. After you solve, how much do you get? Do you get these numbers? After you have entered 3, solve, check if you get these numbers.
Hmm.
And these you will just type in your Excel. And these will be populated.
But this one just highlight and drag it.
No, but these ones,
Yeah.
these should be auto-populated. They're not?
And
Okay, so then go ahead and drag and, yeah, drag. See if you get the same numbers.
yeah.
Yeah, okay.
Same with this one.
Yeah, same with the last column. Yeah. So next. Now, these ones, so these are our optimal portfolios. These ones are from our efficient frontier. So we are going to go there. Check. So we have 0.13113509, right? So we'll copy 13 and then 1135. So we don't, we don't have 0.12, so we cannot copy all at the same time. So Control C. And then 0.1135. 0.09075. Control C. So do not overwrite this green row. It is already populated, so skip this one. Now 07. Then MVP. And then 0.0573, 0.05, 0.3010. Right?
Yeah.
Okay. Does everyone have this graph? Now you see these are not connected, right? So let's do this. Click on the graph. Chart design. Select data. Edit. Okay, not here. Cancel. Let's go to, where is it? Yeah, hidden and empty cell settings, and then connect data points. So go, after clicking on the chart, go to chart design, select data, hidden and empty cells, connect. Push OK. So to explain what we did. So in the previous case, we charted our entire frontier. Out of the frontier, we found out efficient frontier. Now here we worked with, let's say you can consider these are individual investors. This investor has very low risk aversion. So he can invest more in risky asset. That's why you see 71% and -70 bond, right? This person is very risk averse. 21% in stock, almost 80%, 79% in bond, right? So depending on risk aversion, the portfolio weights change. And what this table does is, as you change your risk aversion coefficient here. So this draws the data from this curve. So if you type 2, it will look for 2 here and plot the utility here. Okay, this there, the formula is there. So for example, for 2, you have 0.632, right? Go ahead and type 3. So this will bring up the utility corresponding to 3, right? Now what it does, remember these are optimal portfolios, these are from efficient frontier, right? Mean variance frontier, because we have the entire frontier, mean variance frontier. Now you see this green, this is optimal portfolio, meaning this portfolio, which has a return of this, risk of this, which is this tangent. Okay, and this line is constructed. So this indifference curve is constructed using this returns and using this risk. So among all these, this has the this is the most optimal for this investor given his risk aversion coefficient. So this is optimal portfolio. You see the tangent point? That is optimal portfolio. So if you bring your cursor in this tangent point, what do you see? X-axis value 9.14%, which is the risk. So 0.914, 9.14%. And the y-axis 7.88%. This is the mu, right? So that is the tangent on the efficient frontier. That is the optimal portfolio for this particular investor. Now, so we talked about, this is an investor who has a risk aversion coefficient of 3. Now, if I change it, don't change it yet. If I change it to 11, what do you think will happen to this portfolio for this particular investor? Will it slide down or slide up? So 11 means more risk aversion. So they want to avoid risk. It will go downwards. Isn't that right? Let's check that. So let's say 11. Right? So depending on risk, so you will see when you open an account or portfolio with Wells Fargo and others, they will give you your opportunity set. That opportunity set is your mean variance frontier, and then they will plot your portfolio, the portfolio that your portfolio manager, Wells Fargo, others have constructed for you. They will show you on the entire frontier where does your portfolio lie. So in this case, if your portfolio, given all these assumptions, is optimal, it should be here. If you have a risk aversion coefficient of 11. Now, where do you get the risk aversion coefficient? We talked about one particular utility function, right? Another way to think about it is, another source of data for this is, remember in the chapter 2, we talked about personality testing, right? So all those ideas will give the portfolio manager some idea. What is your risk tolerance level? And they will have some internal mechanism, quantify it. Okay. Any other questions? Or any questions, I mean? No? So this will not be enough for you to do the homework. So skip the homework and the Bloomberg terminal for now. I'll give you a new deadline. So I have to make some adjustments, okay? Because we couldn't make enough progress.
So we still do the homework, but not the Bloomberg, right?
You will not be able to do even the homework, because the homework is about 5 risky assets. So you need to know at least one new thing. So which I have to discuss in the next class. Okay. Any questions, guys? No?
Could you please
Alright,
upload this
so-
Excel file?
Sorry, say it again.
Could you please upload this Excel file as well?
Uh,
I want to
Excel
see
file?
the process because my answers are mixed. Yeah, this
Okay.
one, saved one.
So, all right, yeah, I'll upload this, yes. All right, guys. I will see you next week. Have a good weekend.